I think it's time someone explained to you how to take income from your pensions or in retirement to be really tax efficient. I'm Ryan, I'm a chartered financial advisor and planner, and it's literally my job to help people like you get reassurance and peace of mind that you're gonna be okay to retire. So, introduction over, let's get into it. When you're looking at retiring, liquidation order is really, really important. The way the order typically goes, and it's different for everyone, but the vast majority, because this isn't advice, is you use your taxable assets first. So that could be your pensions, that could be general investment accounts, it could be properties, and then you use your tax-deferred accounts. Your pension kind of sits within that, so do your general investment accounts, and then you use your tax-free investment. So that's typically your ISA accounts, or if you've got cash sitting in a bank. So when we're looking at this, if you're a person that has, say, a workplace pension, a stock and shares ISA, and a general investment account, you would look to use your general investment account because it's susceptible to capital gains tax and dividend tax. So that's the most inefficient tax products you've got. Then you'd want to use your pension, and you want to use this really, really tax efficiently. So you'll be crystallizing, e.g. taking tax-free cash. It's a very fancy word for it. The effect of taking tax-free cash, and you can take 25% tax-free cash from your pension, is called crystallization or crystallization benefit. Crazy word, I know, let's not get into it. But you don't have to take the full tax-free cash at once. So if you've got £100,000, you don't have to take £25,000 straight away. What you can do is simply take as much as you need. So in the UK, if you're a single person and you want a minimum lifestyle, and I'll get into this in a moment, you need about £13,400 a year, assuming you don't have a mortgage, which is another topic. To get that, if you crystallized £13,400, so took £13,400 from your pension, you're probably going to pay no tax, which is incredibly tax efficient, as you would expect, because 25% of that is tax free. The remaining amount on that £13,400 is well within your personal allowance of £12,570. Which you had when you were working and you had your career and your income. You're not working, but you still get that same allowance for personal taxation. So your effective tax bill that year is zero. In fact, you could take more money and still not pay tax up to that threshold. And then you're in you're in the basic rate taxpayer section. But then once you've used all of your pension incomes, then you would use your ISA accounts because there's no tax to pay. So you want to give them as long as possible to grow and develop and hopefully flourish really, really well to fund the rest of your lifestyle. So most people will use their ISAs at the very last leg of the journey. Yes, it could be tempting to use your ISAs straight away because it's easier than accessing your pension because there's less paperwork. You can just go onto the app or go onto the website and you can just make the withdrawal or go to your bank if you've got an account with your local bank. But you should be using those last typically. Hopefully that's explained it. The next thing that's really important is retirement living standards. And so I'm going to show you on screen a bit more detail about how retirement should be, how much you should be aiming to achieve year on year in retirement in terms of income. So for a minimum standard of living for one person, you would want £13,400. For two people, that would be £21,600. And now think about this. That's a minimum standard of living. The state pension, when you get to 67, 68, and hopefully you retire sooner, you can access your private pensions from age 57. So when you get to state pension age, that's £12,000 a year roughly at the moment, which means you only need like an extra £1,100 if you're a single person, or a little bit more, nothing actually, if you're a couple, because you'll both get your state pension, which is £24,000. So you're well above that minimum standard of living to be above the poverty line. And if you don't get the full state pension and you don't have any savings, the government will top it up. It's called a pension credit. So you will be okay when you get to state pension age, irrespective of having savings or not having savings. But for those of you that want a better standard of living, so a moderate standard of living, you need as a single person is £31,700. And for a couple, it's £43,900. So if you get to state pension age and there's two of you, that's £24,000 of income. And then you just need a little bit extra to boost it up, which should be quite comfortable to do. And if you go and follow those rules I just spoke about in the liquidation order, you're virtually paying very little in tax. You're being very, very efficient with your money. And of course, for a comfortable living standard, which is spontaneous to say the least, it's 43,900 for a single person and 60,600 for a couple. I don't know who's spending 60,600. I mean, I've got some clients that do, but they really go all out to try and spend that money. The majority of people, when they get to retirement, actually find they end up gifting more in their later stages of retirement, in their late 60s, in their 70s, because they've actually saved too much, which to me signals that they've spent too long working. They should have retired sooner, but it's always nice to give to your loved ones. And I would recommend gifting to your loved ones when you're in retirement, if you can afford to do so with proper, sound financial planning, because you get to see the effect of that. But also, you get to mitigate inheritance tax, which is another topic I will cover in another video. So you should definitely drop me a follow. Hopefully you found that useful. Thank you very much for listening.